friends, I'm going to talk to you about something that's really exciting. When you're starting a company, one of the things that you think about in many cases is how do I grow my business? How do I capitalize my business? And then eventually, how do I exit my business? So if you've read my book, Where the Growth Warrior, the seven skills you need to scale your business in uncertain times, one of the things I talk about is having your company be built to exit. And the idea, after personally selling companies and recently buying a company, I want to talk to you about essentially how do you prepare yourself for the eventuality of an exit. One of the things I've kind of spliced in, which I think you'll really love, is I have a conversation integrated into this video with one of my business colleagues, Stephen Nix. So I'm going to walk you through a presentation about how to build your company to exit and all the things that you should know. As well, I'm going to give you a really, really deep taste of what things you should know that could keep your company from getting sold or that would dramatically impact, not positively, but negatively, your valuation. So I want you to listen carefully. And then again, inside this presentation, you're going to see a conversation that's pretty off the cuff between me and a gentleman named Stephen Nix, who's a business partner I've worked with for almost 15 or so years. And we also go into the acquisition of a company that we did together. So I'm excited to take you on this little journey. Enjoy the ride. Okay, so what's our agenda? I'm going to give you a background on me and why I'm here. I'm going to talk about our built to exit insights that you should know. And then I'm going to give you some immediate next steps because I'm not playing with you guys. Like, we got to do this. So, I go really, really deep here, people. So my first company actually started out of necessity. I was a sophomore, junior at Southern Methodist University. And like most of you, I started my business out of necessity. I could not afford to pay for college. I had taken a lot of loans. My family was stressed, and we had someone in my family get really ill. And so I had to find an alternative way to just afford to pay for school and sorority and books and paper. And so I started a little company in my sorority house called D Communications. And it was a PR and communications company that eventually got some data and analytics, which I can tell you about later. But I actually sold that company in my senior year of college. I spent nights when I wasn't taking classes and doing exams and, being a student. I actually spent my evenings building this business. I hired my sorority sisters. I hired friends. I wrote at night. I took paper and did things and leveraged the skills of a couple of the engineers and some of the people I knew in the communications school. Anyhow, long story short, a couple of years later, I have a valuable business with multiple customers, good revenue, and dope cash flow. And so I decided to fund my grad school journey going to business school in California, I would sell that business. I sold that business the year that I left to go to grad school. So it helped propel me. But what I learned is that everything that you create, all the intellectual property, all your big ideas, all of your customers and clients are assets. And so they must be treated that way. When you think about building a business, I imagine that one of the things that you do is you survive moments like, oh, I did this, I survived. I got this customer, I survived. I wrote this proposal, I survived. Everything that you do and that you create, from an application managing your sales force and your team to your databases of everything, your big ideas, your IP, your proposals, websites, all those things are assets that make your company more valuable. I want you to pause for a second and look up something called goodwill. Goodwill is an element of value in your business that most of us don't think about. It's that press release that got picked up. It's the logo. It's the copyright. It's a video that you did up on YouTube. All the experiences that you're building into the backbone of your company are assets that are saleable. Someone wants, needs, desires everything that you're creating right now. And so I learned that pretty early on. So I go to grad school, and between my first and second year in grad school, I meet this phenomenal woman named Barbara Britton. And I didn't deserve it, but she gave me a great job as her intern at BEA Systems. So between my first and second year in grad school, I was learning about mergers and acquisitions at a 9, 10-figure level, blown away. So 7, 8, 9, 10-figure level. And I got this perspective from this person who'd been a really successful entrepreneur and executive. And I started to think about in my second year of grad school, how do I become part of this entire tech ecosystem where you create an asset with low marginal costs and it just explodes and becomes valuable to others. We did the BEA IPO, BEA Systems, named after Bill, Ed, and Alfred. I had a lot of roles there. Started my career in the product side of the business, which was so phenomenal, and product marketing, and then left that company to go found a company. Later on, BEA was bought for Oracle for $8 billion. So a company that I was part of in the beginning became and created $8 billion in value. So I leave BEA. I go and build an organization that does some unique intellectual property that I've been working on, which was essentially voice of the customer. And so we took that company from a services offering to a tech-enabled service. Then my exit 5 years later was my team actually doing a leverage buyout and buying the company from myself and my partner. So again, what we learned, goodwill, creating value. And then I go and start my own company as a founder, software as a service, a company called Upwardly Mobile, or Upmo. It was in the career management space. I'm going to tell you, not everything you do is going to be successful. So started a successful company, went to grad school, was one of their youngest MBAs, got into BEA, exited, had a great experience there in a run-up. And then I started a company that wasn't as successful. We had built a technology product that was incredible. I'd written 2 patents for that product, and we were extremely successful as a concept, but the business was about 10 years too early. And so after a few years and after pouring my heart and soul into that company, we realized that, the company wasn't going to be a massive exit, but I'd raised money. We built a product. We had intellectual property. We had customers. We had patents. And so we actually sold the IP to our largest customer. So that was an exit process. So again, you've heard me. My first company I sold to a customer. My second company was eventually sold to a massive global juggernaut, Oracle, and we sold that company to the public markets via an IPO. Then I sold another company to my management team, my executives, through a leverage buyout. And then we sold that company to a group of customers. And so that was how we exited Upmo. So then I become an executive at a company called Jazz HR, and we raised over $20 million. Yes. And we sold elements of that company, parts of it, to the venture capital community. So you can go and do research, but Jazz HR was an HR company that was creating a platform for managing people who are interested in jobs. And we had several thousand customers, and the founder and I went out and sold parts of that company to venture capitalists. So when people talk about raising money, essentially they're raising money through an equity sale to another party, either a private investor, a family office, private equity, or to venture capitalists. You are selling parts of your company. So you're effectively exiting, but in an incremental way. So we did that at Jazz HR, and then just had a great experience there. From there, I became the CEO of a company called Tap Influence. And I'll talk more about that later. But what I want to give you a sense of is we eventually sold that company after a turnaround. We sold that company to a public company called IZEA. And so that was about 3.5 years into my role as CEO. But what I want you to really get from this conversation and this setup is buying and selling companies is a journey. And so to whom you sell that company really depends on the stage of the organization and what your desired outcome is. So I've talked to you about multiple types of exits. I'm going to move you through this presentation so you get a sense of how. This is my favorite part of the conversation about build to exit. So when you're selling a company, you probably imagine yourself on Shark Tank. You've got all these people who are so interested in what you're doing and are excited about your brand, and you're stoked and you're thinking about, how do I make value and how do I make money for myself, and how do I get billions of dollars for selling my company? Well, friends, very few companies sell for billions of dollars. Very few companies actually sell. And here's why. If you're looking at my screen, what you see is on the left side is the seller's calculus. So you are the seller of your business. And on the right side, you see the buyer's calculus, like what are they actually thinking about and what matters to them is what I call the calculus. And so think about it on your side. You've got a list of things that you think make your company dope. You've got this idea, like this valuation multiple. You're doing 10 million in revenue or 1 million in revenue or 10,000, and you think, I'm going to sell this thing for $100 million. So you've got that in your mind. You're thinking about all the sweat equity that you put and poured into this business. You're thinking about, how does it feel to sell this company? What is my team? What's my brand? What's my culture? How much customer love do I have? What's my legacy? All this goodwill, my reputation. You're valuing all of these things to the greatest possible degree. So in your mind, this company is worth a literal Google of dollars, okay? Like you're just like imagining how awesome it's going to feel when you get that $100 bazillion, that $100 million, multi-million dollar exit. Most companies will never get there. On the right side of my screen, what you see is the buyer's calculus, and they're thinking about two things. How do I arbitrage myself into getting the best possible deal at the lowest possible price? And the second thing they're thinking about is, how do I mitigate the long-term risk of this acquisition? And so if you're selling your company, you think the value is here. And as a buyer, you're just trying to manage for upside so that you can ensure it's there, and downside so that you can avoid that. So imagine as a seller, you're thinking about all these things that you want and that you believe are valuable. And as a buyer, all you want to do is, how do I get the best possible return without losing my shirt? I saw this data point, and it's going to blow your mind. Mergers and acquisitions often fail. The failure rate of mergers and acquisitions, according to Harvard, is 90%. So if you're looking at my screen, this is the best, I love this quote, friends. M&A is a mug's game. Typically 70 to 90% of acquisitions are abysmal failures. That's Harvard, friends. They have access to all the data in the world. So essentially, when you're the buyer and you're thinking about shelling out a lot of capital, you know this number, 90%. You're thinking, there's 9 times out of 10 this is going to fail. And so how do I avoid the failure? And then how do I ensure the best possible upside? So that's the buyer's and seller's perspective, which is that it's not going to be successful. So if you're a seller, I want to speak into your heart at this moment and really talk to you about what's important. There are several things, and this is actually where we're going to cut into a quick conversation between myself and Stephen Nix about buying a company. So we recently bought a company, and going through that experience, really, I saw that there were some real learnings. We had built a thesis for buying a company we were interested in. And so we evaluated over 80 businesses and then decided to buy one of them. And what we learned is that there are 3 things that drive down or drive up and impact your valuation. So take out your pen and start writing. Okay, I'm going to use some rough language here, so if anyone gets triggered by that, just a heads up. So on the positive end, there are some companies who sell for much more than they're worth. So how do they do that? I call it the 5 stars of FOMO. The fear of missing out positively impacts your valuation and accelerates your deal. So if you're selling a company and people are afraid, this means the buyers, if they're afraid of missing out, you are going to get maximum value for your business. And it's going to happen faster. So what you want to think about is not having one buyer. And again, think about this in terms of raising money, friends. So if you're selling anything, this is what you want. You want to create a market of people and opportunities who really believe that your company is outpacing the market or has some unique value prop or intellectual property or a moat or something that no one else can have access to. You want to create FOMO. So a well-run business with a big market of people interested in buying it is the best and most most delicious FOMO possible. Okay, that drives up valuation. Here's what makes valuation kind of what I call fragility. So fragility is you've got one executive. Fragility is you're running out of capital. Fragility is you've got a lot of bad deals and customer contracts that are either in dispute. It's essentially anything that raises the risk of your company to the buying company. And that fragility takes that 5 stars down to 2, meaning you're going to suffer valuation, your deal's going to take longer, and just might not happen. The last term, friends, is called fuckery. And I use that language because I want to shock you. If there's something in your business where the buyer looks at it as a deal breaker or showstopper, that is the F word. That means that not only are you going to have a lower valuation, there's a high probability your deal will never happen. Stephen and I actually talk about that in the video you're about to see, but I want you to think about it. Fragility is when something in your deal means that in the future it could cost the buyer money. The F word is when they are guaranteed to be somehow negatively impacted by what your company has done. Very different. It can't be quantified, it's bad, and it's in the future, and they're gonna hold the bag. So that is what you want to avoid while running your business. So when I'm talking about built to exit, the F word is anything crazy going on in your business is going to be discovered in due diligence, and so it's likely your deal won't happen. Fragility, you can build around that. Think about having a team of people that your buyer can be confident will run and manage that company. Do your deals right. Have great corporate hygiene. And then FOMO is have a great business that people really want to buy. Have happy customers. Have a sticky team. Have growth, and have a market around your deal. So FOMO drives up and makes deals happen faster. Fragility makes deals happen slower and drives down valuation. The F word is a bomb that you want to avoid. Okay, so I walk through in this next video a quick overview of what Steve and I go through in buying a company. So nothing to see here other than for you to listen and watch this video. Enjoy. I wanted to use this call to do some planning. I had a great call with Danielle this morning. But I also talked to the Growth Warrior team, and they were like, we need more content to start to publish. And I was like, the conversation that I've been meaning to have is with Stephen about this acquisition, essentially 2 years later. So I guess that's my question. So imagine there are a bunch of entrepreneurs who are watching this who are thinking about either selling or buying a company. You and I bought a company almost, 2 years ago. And it was my first acquisition. Obviously, I think that was yours as well.
It was, yeah.
And you led a lot of the due diligence side. You led a lot of the, key parts of the negotiation. What were some of your lessons learned from that experience? As you reflect on how we approached it, what you wouldn't do and would do again, what were some of the takeaways?
Yeah, I think if I kind of look at it sequentially, I think one of the things that we did early on that was really helpful was we got access to a lot of the customer data from the company we were acquiring, right? And so our ability to have that raw data and to be able to analyze it the way we wanted, right? So rather than them saying, this is our churn rate or these are, these are, because it allowed us an ability to dig. And so coming to a level of trust with the company we were purchasing, where they were willing to let us do that, was, I think, probably the most meaningful thing in terms of trying to understand the health of the company.
Right.
It was interesting, though, as we kind of started looking at all of the documentation you needed for an acquisition, it was surprising how hard it was to get it organized. And because I tend to be a little anal retentive, right? One of the things we did was we created a shared folder, and then we named each folder for all of the different documents that we were requesting. And so they were able to put them in there. We were able to review them. The attorneys were able to see them. I think having that kind of a structured approach, you could do, there would be many ways, right? You could have a shared room on many different platforms as well, but we just used Google Drive, and it worked really well. And it allowed us to really do a thorough review. And one of the things that always makes me think about is kind of the management of our own companies.
Yeah.
Right. And so I actually keep all of our corporate binders electronically, and I keep them organized in that same fashion with the belief that someday everything that we're building gets acquired, right? And so it becomes really easy on the selling side to offer what you need to for due diligence, because you've kept your
Right.
corporate records. And by corporate records, I mean it's much broader than just kind of the corporate books, right? It's all of the contracts, all of the HR stuff. I mean, it is organized in a structure, so it's able to just be passed over as part of an acquisition.
Well, I remember
Option.
you saying the word hygiene like 50 times as we went through this process, because some data was duplicated, some stuff we couldn't find. We had to recreate with their counsel a lot of docs. So, you mentioned the whole corporate hygiene. Most people don't do a good job of that. I mean, how would you approach it? So if you're a founder or a CEO and you've got a couple $1 million business, do you go back and fix that stuff? Do you have someone who owns it? Like, what are some ways that you can stay ahead of it? Because a lot of what we saw was it was at the end of a deal. We're trying, there's not a lot of energy to go backwards.
Yeah, so I think you kind of have to draw a line in the sand, right? I mean, I think the question of how much do you go back and clean up historically, I think depends on how old your company is.
Right.
If it's just a couple of years old, it's probably worth the effort of going back and cleaning it up.
Interesting.
You know, because it's not that hard, right? You just start to collect stuff over time, and you probably have stuff in other places, and it needs to be organized anyway. But I think it's kind of a moving forward thing, right? Like the question for me always of going back and cleaning up is, do I do it now or do I do it later? But what you want to do is you want to stop contributing to the mess, right? So you want to draw the line in the sand today and say, okay, from today on, we're going to be organized, and we're going to know that as of X date, everything is in
Yeah.
this, and everything prior to that is going to be a little messy, and we're going to have to go back and clean it up. But at least you stop the mess, and it really is around every contract you sign, every vendor agreement you've got, every customer agreement you've got, every employee agreement you've got. It's around shareholders, right?
Right.
If you've got convertible notes or other thing, are you properly accruing interest? Do can you show what those things are at every point in time? Because your buyers are going to be really curious on anything that impacts the cap table.
Totally. Or it comes back as a potential liability for them or a risk. It's interesting. In my reflection, I've sort of thought about the due diligence process, as you see Roscoe's pacing, as sort of so there are things in due diligence that are deal stoppers, that are things that reduce valuation, and things that just make the deal harder. So what would you put in the deal stopper? Like, if you were going to acquire a company, what types of due diligence would you find that you basically would say, I'm just not going to do this deal with them? Like, what would make you back out of something?
Yeah, we had a really good attorney we worked with. If you were kind of on the most recent acquisition,
Yes.
I think anything that could potentially affect the valuation of the cap table was really, really critical, right? So
Right.
if there was any transfer of stock, or if there were any loan documents or any sorts of those things, they really had to be tight. One of the things that we found in our acquisition, right, was that a lot of ownership had been held in companies, which makes sense, right? I mean,
Right.
we all are not holding stock directly; we're holding it. But that also means, though, that the hygiene of those companies has to be documented and has to be proper, right? So if company A LLC owns this person's shares, and that person sells them to company B
Right.
LLC, the hygiene of both of those companies, right? And knowing that the transfers happened with people who had proper authority, right, it is important. And some of that is easy, when it's corporations in California, for example, all that's easy public record. You can go back and verify it. Other states, Delaware and others, aren't as easy, right? You can't access those records as easily, or foreign companies. And so really, we went back and we traced every piece of ownership coming and going, and we looked at every entity to make sure that that was really signed. Because if you think about building a company to 20, 30, 40, 50 million, or whatever you're growing it to, somebody who has an early claim to that might be wanting to come back and say, I never sold my ownership of that.
Totally, totally.
And so that's really important. I think anything that creates a liability too, right? So IP, for example, we have a lot of images and other and third parties creating content for us, and we acquired a lot of that, right? And whether the ownership of that was properly documented and who owned that was really important to us. It affects valuation, right? It's one of those things that we were acquiring. So if you are the seller, if you can't document that your IP is properly protected, it's problematic.
It's funny. It's like there are three areas that have either a showstopper or deal breaker or a valuation impact. So legal issues. So like you talked about, formation, lawsuits, that sort of thing. Anything affecting the balance sheet or the cap table. So ownership, and debt, and then intellectual property. I know that when we're looking at this company, there weren't a lot of legal issues, but there were certainly a lot of issues around intellectual property. And so, like, who owned what? And then we also had a foreign corporation, right? So there was all this. So when you were doing due diligence, because you led that part, what did the team look like that was working with you? So, like, did you have someone on forensic accounting? Did you have someone on legal? Did you have to get a legal opinion from outside the country? Like, what did your team look like as we were acquiring this business?
Yeah, so the primary person we worked with was a guy, an attorney whose first name is Mike, and Mike was really detailed and had been through this a lot of times, right? He had come out of a big firm.
Yes.
And so he really understood the nuances of where the liability was. And he understood also what the selling party should see as reasonable, right? And so Mike was the primary person that I worked on. From a financial side, we worked with a guy named Jason who has a strong financial background, right? To look at some of the numbers and to say, okay, with the underlying raw data that we have, does the reporting that they show match up? We worked with our corporate accountant, right? Because we had to look at all the tax returns to make sure the tax returns made sense, and had all the tax returns been filed, and had they been filed correctly. So we did all that review. And because there was ownership in a foreign country, we actually had to hire an attorney in a foreign country who could really authenticate some of the corporate transactions in that country, right? And could tell us that the changes of ownership and things were valid under that country's rules.
It's interesting. The corporate hygiene question was something that you brought up a lot. And as I work with startups, I just see a lack of focus on it. And I remember you recreating their unit economics and you analyzing and building macros and spreadsheets, like just to get to a reality of what their business was took a lot of work. And I feel like that has a deleterious or negative impact on valuation. So if you're asking the person who's buying your company to figure out what it's worth, right, by doing all this analysis, I think you're inherently setting yourself up.
For sure. I mean, well, there was a lot of work on our side. It was actually an advantage on our side in terms of pricing or cost to us, right?
Absolutely.
Because we determined what that was rather than them coming with well-documented models that showed this, right? And so it was left to us to do it. And I do think as the seller, you would rather control that. And hygiene comes around two things, right? It comes around the legal and corporate stuff, and you can either do that yourself or you can hire someone to do it, but you've got to do it, because if you're not following your corporate hygiene, you may not even legally have a corporation, right? So that's an important piece. And then the other side of it is the financial hygiene, right? Like how do you go back and show multiple years of financial statements, and as the buyer naturally focuses in on certain things and asks questions, are you able to answer that? Do you have the data, and have you kept those records?
And what's so wild about that, and what I think is a missed opportunity, is most startups start out so happy and so excited, and they just kind of miss that hygiene. I think going back and fixing it and addressing it, to your point, is obviously a good idea. Not stopping the bleeding and not doing it going forward. So saying, okay, at this point, I'm going to move forward. But this idea of having clear models and metrics around the business, I feel, is potentially the biggest one. So if you haven't done anything illegal, you're probably not going to have any legal issues that are to speak of, right?
How much you want to spend cleaning it up.
Exactly. The balance sheet stuff, that happens, and everyone expects there to be some level of, oh, there's 0.1% that's out there that wasn't accounted for. Like, that happens. Intellectual property, that's a big deal. In terms of who owns what, really gets in the way. So tying that up seems like the biggest thing. But this idea that you don't know what your metrics are has a direct impact on valuation. So when we were doing the valuation of this company, how did you think about multiples, and how did you think about what metrics made sense for sort of assessing what the value was of the company?
Yeah, it's interesting because, the company had positioned itself for sale as a SaaS company.
Yes.
But it wasn't really a SaaS company yet, right? Because the first S in SaaS is software, right? It wasn't a software company. It was a subscription business for sure, and it had subscription revenue. But the multiple of that was very different than SaaS multiple, right? And so, part of our model in buying it was understanding that, wanting to acquire reoccurring revenue and convert it to SaaS revenue with technology. Right. But the the metrics, one, I think you just kind of have to understand, like, what are you, and have you actually accurately defined yourself? Because the buyer will, right? The buyer is not going to be snowed, right? Because it's there, they're bringing a lot of money to the table. So, do you know what you are? And then for that industry, so let's assume you're SaaS, just for the sake of conversation, do you know what your key metrics are? And what are the key metrics for your industry, and what are the benchmarks for those, right? So there are benchmarks for churn and LTV and all of these things, right? And so what we did a lot of, right, was creating those metrics and then looking at them for the existing business model, which was a subscription business but not software, and then looking at how those would play in the software world, right? And so if we converted it over to being software, how would we manage that? But I think it really was kind of understanding at the highest level, what were the industry metrics, and then how did the company measure up against that?
It's interesting, and you're absolutely right, because when we got into it, we had to come up with, okay, what is this business? So that was step one. Like, is it a content business? Is it an e-commerce company? Is it a software as a service? Or is it a transactional business that is just masqueraded itself as? So there were all that, what is this thing? And then it was, okay, what are the multiples of that, of revenue? Or is it of EBITDA? And so we looked at both, right? It's like, okay, top line revenue, or is it profit driven revenue valuation? So profit driven or top line. And then it was, okay, can we validate that the metrics that we're looking at are accurate? And
over time, right? I remember we were looking at data at one point. We couldn't understand some of the historical data and trends. And we looked back, we realized that they had done a system conversion, and they had done a system conversion without thinking about how it was going to affect profit well, which was the tool they were using to track their metrics, right? And so there were these odd spikes, but those spikes were actually people being converted from one back-end system to another and showing up in profit well as new business. And so, talk about hygiene, that made it almost impossible to go back and compare, which is why we asked for raw data to be able to go back and do it ourselves.
So I wonder if you feel the same way. Like, going through this experience, it feels like it's really about trust. Like, through the whole process, you're either moving away from the deal or moving towards the deal based on the business's ability to keep its promises to us in the process, and to be credible in the process. And so I know I was very sensitive. Like, if we came across something like that, where we saw a chart that had revenue spiking and it was really just a system conversion issue, I lost trust, right, in that moment. And so how did that affect you? Like, the idea that you're going into this negotiation as equals, you want to trust each other, and if at any point that trust is lost, there's no longer a deal.
Yeah, I think as it relates to that particular issue, they just weren't sophisticated enough in the way they were managing to know what had happened or to even kind of be alarmed by
Yeah.
it. So I think they had demonstrated. The good news on this deal, right, was they had demonstrated enough about being open and providing information and data. So as we started
Yes.
looking at these things, it wasn't problematic,
Right.
right? Because I mean, it was problematic, but it wasn't problematic from a trust perspective because we didn't believe that they were trying to deceive us, right? But had it been a and they were, I think they were unusually open. Uh,
Yes.
I think had they not been that way, that might have been one of those things that kind of rocked the boat where you said, "Oh, I'm not sure. I'm not sure I trust these people."
And Stephen, I feel if I were to give advice to a founder or someone selling a company, I would err on the side of being abnormally open, right? Because that you walk into it knowing that there's a high probability that it's going to fail because most acquisitions do, and you walk into it knowing that there's either data that you don't have access to or data that no one remembers that could affect your experience of running the company or owning the company. And so trust is a big deal. And I found that them being easy to get information from, easy to apologize if something was misstated, was actually good for us because it's like, okay, you assume good intent versus, you know, can I trust these people?
Yeah, and I think I think if there's not good intent, I think the acquisition is going to be very difficult, right? I mean, I think it, there's a lot of conversation, a lot of dialogue, and you have to trust them, and they have to trust you, right? They're handing over a bunch of competitive stuff, and of course you've signed non-disclosure agreements, but there's still risks in doing that,
There's still
right?
risk.
So they had to trust us, and we had to trust them, and I think it was building that trust that got the deal done in the end.
It's funny. I've been done a couple of these podcasts, and one of the things I talk about is someone shared with me about a year ago that one of the roles of the CEO is to own the ethos and the pace at which the company moves. And so, as I think about that, I think about the team that we had on our side working on the deal versus the team that they had on their side. And I found that like the pace, the pathos and the ethos were so different from ours and from the seller that it actually created a lot of friction.
Yeah, I don't think that their attorney, I don't think, was a sophisticated attorney in this particular area. It might be in many other areas, but had not, in my opinion, did not have a lot of acquisition stuff. Because one of the things that we benefited from was Mike, our attorney, telling us,
Right.
"You're being reasonable," or "I don't actually think what you're going to do is reasonable," right? And so we had those conversations, and he would say, "Yes, of course you could ask for that, but if I was on their side, I wouldn't do it."
Right.
And then other things where he would say, "I don't understand why they won't do this. I would never tell my seller not to do this," right? And so I think had Mike had a partner on their side who had that same sort of attitude, it would have worked faster. I mean, the personality of the attorneys and
Yeah.
the attorneys' ability to work together um, is it really important. Um, we got to a point because one attorney I think really outpaced the other in terms of experience in the area. We got to a point where the attorneys weren't talking really effectively
Yes.
to each other, and we actually had to have the seller, the CEO on their side and our side. We had to get on the phone without the attorneys to basically say, "Okay, look, these are the issues. Let's just make sure we agree." And so we were very clear what we wanted from a business perspective. We were
Right.
and we were, I mean, really explicit, like on point A, do we agree to these? Yes. Okay, on point. And then we just gave it back to the attorneys. And I think I wrote the email to both attorneys with the other guy on copy and just said, "We agree to these business terms. You guys need to figure out how to codify it."
Go on and figure it out.
Yeah.
I mean, a lot of money gets wasted there, right? Is in the fighting and in the battle. Because I thought there was very little contention between us and the seller, but a lot when it came to just legal. So let me summarize what I've heard so far. I mean, you talked a lot about corporate hygiene when we were going through the process, and now, and how important that is in kind of slowing down a deal, right? Legal, balance sheet and cap table, and intellectual property related. Like those are three big important categories. You also talked about having command of one's models and metrics, and that being something that if you leave it up to the buyer, you're definitely losing valuation because they're gonna discount what it is you're coming to the table with. Also, the openness of the seller and the buyer in terms of like how they're determining valuation and if there are any flubs during the process.
Yeah.
And the last point is one that I think creates a lot of frustration and potentially bad will is when there's battles between attorneys where because there's no value getting created often in that battle, right? It's just cost.
Yeah, and you sometimes have to ask your attorney, like, well, so if I don't agree to this, or if I agree to their side, like, what is it actually costing me? Because the attorneys are paid, right, to look for corner cases.
Yes,
Say, well, this could happen, and then you have to ask yourself, well, how likely is it that
that's
would
it
happen?
happening.
And if it happens, what risk am I actually exposing myself to?
Time kills deals.
Yeah.
And a lot of time gets added in those corner cases. So let me opine for a moment, if you will, about the valuation and the money side. So I feel like the three things I've learned are obviously having someone who is phenomenal at due diligence, because I remember going through the folders that you created and they were alphabetized. And I literally was like, who is this person and why? Who is this guy? And so that was one. But two is, I feel like companies that get acquired have their own unique and respective value. But if you're acquiring a company, and this is going to sound crazy to you, this is why I think SPACs are brilliant, is if you're going to buy a company, it's often best to understand who that direct customer is of the company and potentially buy a whole suite. So multiple companies, or to weave together more than one thing to create a net new thing.
Yeah, so you can create more value that didn't otherwise exist.
Exactly, because when you buy one company, you're 100% reliant on just the engineering to make that company perform better. Versus, let me create more value in the market than could have existed before. And so that I feel is something that I've learned is doing one acquisition makes sense, but doing two or three where you bring something completely new to the market that's transformational. And then the third is capital. I feel like, people raise money because we raised money from investors to buy this company. And if I could go back, I would do 1/3 of the 1/3 of what we raised to buy the company, and 2/3 to invest in it.
Yeah, it's when you acquire, it is your best opportunity to raise the capital.
Yes.
And so, I think that would be my do-over as well. I think we would have moved faster to where we finally got, right, into the success we finally got, if we had raised more capital, either spent less to acquire or raised more, right? Because it was as we were acquiring, it was easy to raise capital, right? And then once you've acquired, people are like, well, you just acquired it, so let's wait and see.
Take some time.
And then you wait and see, well, you've only had it a year, let's wait and see. It's like, so, that window, that is a magic window that,
yes.
That would be, if I got one do-over, that would be my do-over, more money at acquisition.
Same here.
More investment money. Yeah.
More investment money at acquisition. And I would buy more than one thing.
Yep.
And I also feel like someone's got to be on the business and someone's got to be in the business. And so I feel like one of the things that I think we did okay was one person is analyzing, is this still a good deal? And you remained objective the entire time. I'm not sure how you did that. I was so emotional. I was like, this has to get done. But someone being excited, because you need a vision for that business, because once you acquire it, you don't have 2, 3, 4 years to figure out what you're going to do. You kind of want to have a game plan on day one, or at least on day 100. And so having someone who's evaluating and someone who's also living in, I think has a tremendous upside.
Yeah, I think you get less time than you do when you start from scratch, right? Because when you start from scratch, you're starting from scratch. But when you buy, you're buying something that's already operating. And so I think that was probably a little bit of a surprise for me, was that because for us it was new, but
Yeah.
from the investor perspective, it wasn't new, right? And so the time horizons were tighter than they had been when I had worked on stuff that was actually net new.
Yeah. Yeah. All right. Well, thank you for letting me talk about this. This was a great experience, and thank you for leading the diligence and operations and kind of figuring out the right value. I mean, I'm kind of looking back, going, "What exactly did I do in that process?"
A lot, a lot.
But no, thank you. And I think this insight's huge, because if you're gonna sell your business at some point, and so having a knowledge of what a buyer is looking for is it's important. All right, so I'm going to talk. You just saw this incredible video of me and Steven. We're sharing real information with you. We just bought a company. And so in that video, you see Steven, who's just an unparalleled business leader and partner of mine. So I brought Steven in as a partner on this deal. So I had foresight. I brought Steven in, and I had him run the due diligence process. And so he saw from the inside how the F-bomb, FOMO, and fragility actually affected this deal that we just did. But I want you to know 3 ways to drive up FOMO. Number 1, grow fast, own a niche, and have a path to a big market. Everyone says start small. I agree, but know that you're going after something big. Number 2, create a market effect. Get multiple people interested in your deal. Number 3, it is your job when you're selling a company to think about the buyer. And so FOMO is that you in your mind actually have an idea of what your buyer is going to do to grow and increase the value. So three ways to drive FOMO. Number 1, grow fast, own your niche, have a path to a big market. Number 2, create a market effect by essentially having people interested in doing your deal, multiple people, multiple buyers. And lastly, think about your buyer as your customer and know what's going to benefit them. Okay, so now these are things to avoid. 3 common points of fragility. Number 1, single point of success or failure in your business. One leader, one customer, having deep customer concentration, one channel, one geography, one product. Anything where there's a single point of failure is going to cost you in your business. Number 1. Number 2, running on empty. We saw companies when we were buying that had no cash. And if you want to tempt a buyer, that's the way to do it, because your value decreases the closer you get to that explosion point. And so fragility in your business means you don't have lots of time. And then last point of fragility is that there's some external reason, some regulation, something that's changed in the market that is out of your control that could cost your business. And so the common points of fragility you want to avoid is single point of success or failure, running on empty, or some external factor that's going to make your business less valuable or at greater risk. And then lastly, the 3 deal-killing elements of the F-bomb. Number 1, a daisy chain. If you exaggerate, if you lie, if you don't tell the truth, if you slow down diligence, if you're not rapid in responding, I'm telling you, buyers will run away from your business. Number 2, if you in your mind have watched Shark Tank and you're like, you know what? This company is worth $100 bazillion and here's why. When you're thinking about selling your company, you're entering into a market. You don't want to concern or conflate or confuse the fact that buyers create the market. You don't. So valuation and what the company is worth, it's actually just an impact and an effect of what the market's willing to bear. I'll give you a quick story that'll, I think, illustrate this for you. A few years ago, I had a really beautiful home that I loved. And we went to sell this home for about 50% more than what we bought it for 15 years earlier. And I thought, this will be easy. It's only 50% more. Zillow says that it's worth, X amount. And so we list the house. Crickets. Nothing happened. And so after about 6 months on the market, I realized no one was going to buy this house. It wasn't updated. It wasn't exciting. The market wasn't that frothy. And so we took the house off the market. Then did a down to the studs remodel, just blew it out, and the market there were 11 people interested in buying that house once we completed the remodel. Now, that's an example. If no one's interested in buying your business at that moment does not have a valuation. If you have a lot of people interested in buying your company, then the valuation of that company, its market value, is going to be determined by the people buying it. So the more people you have, the more opportunity you have to increase that value. But stop watching Shark Tank. I got to tell you, your company's value is not determined by a multiple or some crazy idea. It's really based on the performance of the business and the number of people interested in buying it. Lastly, and you saw this in my video with Steven, bad corporate hygiene, lack of documentation, you didn't do your taxes, you don't have, there's no paper trail for this business, is a deal killer. So those are the F-bombs. Daisy chain, which is an exaggeration and mismanaging of your process. 2 is being too fixed on what the valuation should be. And 3 is bad hygiene. You can avoid all of these. Now I'm going to talk to you about what I want you to do right now. So get those journals out again. I want you to write these 8 things down. Like, really take this to heart. I've sold companies. I've bought companies. I'm telling you, when you're thinking about selling your company, these 8 factors will make a huge difference. Okay, are you ready? So position yourself in the market. More FOMO, less fragility, and no F-bomb. First, always be out there. Always be out there talking to your competitors, your friends, your partners, your customers to assess the timing on your market. And I can tell you so many great stories about this. But be out there talking to bankers, to your bank, talk to your lawyers, talk to your accountants. Always have conversations that are not tactical, but that are strategic. Number 2, get more friends. Talk to your competitors, talk to your customers, iBrankers. Someone wants to talk to you about your business or theirs, pick up the phone and have that conversation because you're learning about the market and that data helps you. Number 3, have someone come in and audit your business. I was running a company that I'd gone to do a turnaround, and the first thing I did was I had an accounting company come in and do an audit of our business. I had a legal company come and do an audit of our business. I learned about our company through the audit. So knowing what risks are in your business is your responsibility, whether you've bought this company, it's been your family business, or you've been running it for 10 years, there are things in your business that you cannot see. And so I highly recommend, number 3, is that you audit your business and you get people on the legal, HR, and accounting side to help you do that. Number 4, hire a mentor, ask better questions. I gotta tell you, one of the things that I learned, so in my background, you may not know this about me, but I used to be a ballroom dancer, a competitive one. And I had spent years practicing on my own, learning how to become a better ballroom dancer, and I got a mentor. So a coach is someone who is great at helping you think about your business or think about your own personal growth. A mentor is someone who's actively in the game. They're learning, they're growing, and they've done what you've done. So when I say a mentor, I say someone who's been there, done that. Okay, so back to this ballroom dancing story. So I was a competitive ballroom dancer. My partner and I were doing really well. And we got 2 coaches. They were world champion coaches. They were from Lithuania, and they were actively dancing. And so we not only learned about how to have better technique or how to just dance in the music and be on time and really cultivate that, but we learned as they learned. They were competing 10, 20 times a year. They were working with the best coaches. They had mentors. And so all that insight actually trickled down to my partner and I. So why I'm telling you this, not only do you want someone who has sold their business before, you want someone to be your mentor who's actively running a business, hopefully bigger than yours, who's also learning and passing those learnings on to you. I feel very passionate about that. That's number 4. Number 5, when I was buying a company, the thing I valued most was being able to talk to someone who wasn't the CEO. So number 5, empower your legal finance team as business partners, because the trust comes when your buyer can have a conversation with you that then is also repeated in kind with your legal, your finance partners, your accountants. So not that you want to influence what those guys say, but you also want them to be able to speak about the business in an intelligent way. So empower them, don't control them. Number 6, that was number 5. You you drive the deal. When I sold my last company, I hired an investment banker, and I was really, really clear that I was going to drive the process, and I needed for them to be a critical lever at key stages. So I was responsible for having the relationships, knowing the competitive landscape. I was going to own the overall process, and I was going to pull my banker in to really help add value at specific phases. A lot of people bring in bankers to own and drive the process and to be responsible. That means that that person's probably got other deals they're doing. They're not as passionate about your business as you are. They don't know the market or shouldn't know the market as well as you know it. And really, you're the most incentivized person to go out and make it happen. They've got a portfolio. You've got one company that you're running. And so when I say drive the deal, I mean that you get out there and it is your number one priority. You know, you learn, you study the market, you drive the process around you, and you bring in experts to amplify your efforts at key stages. Our bankers were so great at creating the documents and the reference material and also working the legal and accounting side at the end. But I was the magician actually talking to buyers, strategizing, researching, and driving that deal. And they just helped with essentially accountability at the bookends. And I call number 7, be an owner, know the market, know where the gaps are in your buyer's business, the biggest areas of opportunity in the market. Always be thinking about where the possible exit points are. You can be bought by someone who loves your product, is your vertical partner, a horizontal partner, a competitor, someone who's thinking about getting into the space. You could have a number of possible partners. So it's your job as the owner, the business CEO, the founder, to really be thinking about that and to be broadening your own horizons. Last, stay smart. Start smart. Ask yourself when you're building the business, before you really get into, hiring teams, who would buy this? And when would I sell? Start smart. Start with the idea that I'm building this beautiful company with the idea of an exit outcome. And so these were 8 big things, guys. If you build your company to exit, you will fundamentally change how you run your business. You'll talk to more people. You'll be more open. You'll have more hygiene inside of your business. You'll have a team that's empowered, where it's not you as a single point of success or failure. You'll really be an owner of the market and talking to people who are affected by the business moves that you're taking. So that's it, guys. A lot of information. Please thank Stephen for coming in here and doing this video with me. This was a long, powerful, impactful thing that I want you all to be thinking about. But your business has value. You don't get to determine what that value is, but you get to heavily, heavily influence it. And I want you to start smart. So if you run a business or you're starting one, I want you to start asking yourself the question, how am I built to exit? All right, friends, that's all I got for you. Send me a note. Love to hear from you with questions and comments and feedback. All right, take care. Bye-bye.